This is a special podcast presentation from 700WLW.com. This is Casey Boland On Demand.
Casey joins me now from Hanghold Capital Management. And Casey, comes to buying a home. I guess some people would wonder, especially you're a couple years into your working life, how much home you can actually afford. And actually, the bank will tell you that, won't they?
Yes, they will, and you'll be surprised at the number they will give you oftentimes. And having dinner with some friends on Friday night, they were expressing the same thing. Back in 2000, when they built a home, the mortgage broker said they would give them twice as much as dollars that they were actually looking to borrow, and they were shocked at this and very surprised at this as they did their own math. They couldn't imagine being able to afford that amount of home, and fortunately they didn't buy that much, but I think that's what contributed to the housing crisis.
Yeah, then you have some people out there who say, well, if I'll take their word for it. If I qualify for that, I might as well spend it, and sometimes for no real good reason.
No, and that can get you in trouble because, banks are going to evaluate you on two ratios. There's what's called the front-end ratio, which is the 28% rule. The 28% rule is going to look at 28% of your gross income, and that's going to be the dollars that are looking to be applied to the mortgage, taxes, and insurance. But then there's the back-end ratio, which is you have to qualify to 36% level of your income, and that's to do with those same expenses. But in addition, those monthly expenses you may have, like an auto loan, a student loan, a credit card payment. But, boy, 36% of your gross income. And I think most people think in terms of their take-home income, and that's really the way you need to view things a little bit more because based on gross, it can be distorted quite a bit.
I think when I was buying a house, the rule of thumb was 25% of your net income.
I think that's a very good rule because I look at it and say 20 to 25% of your gross, and so I think 20 probably lines well where it ends up being more like 25% of your net income. Because if you handle it that way, it'll allow you within your budget to be able to save for retirement, save for emergency expenses. The challenge when you're looking to buy a home, we all have a positive outlook. We project raises and all the positive things are going to happen in life. But what if you lose a job? Also factoring those other expenses along the way that you don't account for with a home, they really add up. So, I think really keeping in perspective, doing your own analysis and work is critically important versus letting someone else tell you how much you can afford.